I think that HIMS has 100x potential over the long term. And join me in this deep dive if you want to find out why I think this company has such great potential going forward. But essentially, the answer is you don't often see a company that can compound efficiency as fast while simultaneously sharing economies of scale with customers. This is very reminiscent of today's greatest companies worldwide, which are arguably Amazon. And now I think the market would disagree more with me, but I think Tesla, in hindsight, is going to be seen as one of these amazing companies. And organizationally speaking, I think that HIMS has similar traits to the ones that these two companies have, and other great companies that I've analyzed in depth that you can find in my blog and now in my channel. So let me explain why I think this is the case. The US healthcare system is an inflationary mess, with him standing out as a beacon of rationality and customer centricity. It is thus far excelling at an enormously complicated task, which is making healthcare convenient, effective, and affordable outside of the existing system while printing cash. You can see in the graph that I'm sharing on the screen now that over 2021 and 2022, HIMS wasn't really printing much cash, but now recently, over 2023, the company has turned into a cash machine. And this is very, very unusual for a company to enter the healthcare space without participating in the pre-existing system and managing to be uh, cash flow positive. So this is truly extraordinary. A review of the history of CVS and Walgreens reveals that today's largely dysfunctional healthcare system is not really the result of malice, but of incentives. It also sheds light on why HIMS may be a generational investment, or why, at the least, its approach is worth watching closely. PBMs, pharmacy benefit managers, connect and negotiate with drug manufacturers, insurance companies, and pharmacies with the ultimate intention of making drugs more affordable to end consumers. But in practice, their incentive is to continually raise drug prices so that they can make more money. PBMs took off in the 1960s and since have become the cornerstone of the pharmacy business. They are not going away anytime soon unless they are forced to do so by regulation. Thus, unless the healthcare system gets meaningfully intervened, prices are going to continue going up. On the other hand, HIMS has embarked on a deflationary journey, far from the reach of PBMs. They have created a vertically integrated infrastructure that allows patients of an increasing number of chronic conditions to frictionlessly access healthcare and receive personalized treatment. Patients can access these treatments, and this is really important, at a price below the amount they would have to pay out of pocket if they sought treatment via the traditional system. HIMS has achieved this by creating an app that connects patients with practitioners and by operating proprietary pharmacy facilities that can create personalized medicines on the go. HIMS is also sharing economies of scale, as I was saying, with its customers by reinvesting cash into the aforementioned infrastructure and dropping prices as the efficiency of the operation goes up. As time goes by, this strengthens the moat and makes it harder for competitors to take share. Over the last few quarters, HIMS has decreased prices for customers that opt into long duration services. Regardless, and this is really interesting, gross margin has been ticking up, coming in at 80.42%, 81.84%, and 83% in Q1, Q2, and Q3 2023, respectively. The combination of increasingly lower prices with rising margins is very, very uncommon, and I also find it revealing of excellence. Check out this graph. In the graph that I'm sharing now on the screen, you can see how HIMS's gross margin has risen quite steadily since 2018 to the TTM, 12 trailing months. And in turn, you can see how, and this is something that I'm going to be discussing next, as the gross margin has been rising, the percentage of orders that they are fulfilling via their proprietary pharmacies, instead of delegating that to other parties, has also risen. What's really interesting is that revenue from personalized products is also up from Q2 2023 to Q3 2023. So here what I see is a company that is very efficiently, very steadily improving its key performance indicators. Merging a digital front door, so an app, with an automated back end is complicated enough. But Hims has been doing this while actively expanding its treatment selection. Hims launched its hair loss vertical in Q2 2021, skincare vertical in Q3 2021, erectile dysfunction in Q2 2023, and cardiovascular in Q3 2023. Management reiterates in pretty much every earnings call that they only pick new verticals that offer a sufficiently high return on capital. Their picks have been excellent thus far, and they have demonstrated great discipline in terms of picking new areas to enter the business. Further, Hims has a considerable dependency on paid marketing, so the above is actually not fueled by organic traffic. This gives Hims all the less wiggle room to print cash, but it still manages to do so. The average payback time for each user acquired via paid marketing for the company is under a year, which I find very impressive. The complexity of the operation is such that its success points to a world-class management. And by the way, Hims CEO Andrew Durham owns 10% of the company, which means that his interests are highly aligned with shareholders. He is also 32 years old, which means he likely has a long runway ahead. The moat of the company is also getting stronger as it drives increased personalization, driven by the automated pharmacies. As these facilities become fully operational, the share of revenue that comes from personalized products is increasing, coming in at 35 and 45% in Q2 and Q3 2023 respectively, as I was pointing out in the previous graph. Personalization further compounds the complexity of the business, making it harder to imitate and more irreplaceable for customers. At a deeper level, however, what is striking is how diligently Hims is expanding its underlying personalization infrastructure. The percentage of total orders fulfilled from proprietary pharmacies has been increasing like clockwork over the past year and a half, climbing from just 50% in Q2 2022 to 80% in Q3 2023. The metric is expected to reach 100% in Q4 2023, and so the information will be public shortly before, actually, I send this deep dive out. A small caveat, however, I spotted the CEO saying during Q2 2021 earnings call that the company expected to fulfill all orders via the proprietary pharmacies by the end of 2022, and this is actually now happening a year later. So take that for whatever it's worth. Hims actually onboarded its ability to manufacture personalized treatments via the acquisition of Apostrophe in July 2021, which at the time had a prominent dermatology business. The acquisition therefore allowed Hims to not only get good at manufacturing, but also enter the dermatology sector. But what's interesting is how unlikely success was. Hims has used Apostrophe's personalized dermatology infrastructure to personalize treatments for all of its verticals, when most acquisitions are a total failure. However, quarter after quarter, the proprietary facilities are increasingly operational and gross margins are ticking up, followed by cash from operations. In aggregate, my impression is that either Hims is a statistical anomaly in that all these very unlikely things have happened at the same time, or it is managed by exceptional individuals. Either way, it is on a course of rapidly increasing efficiency, coupled with economies of scale shared, that stands out as a truly disruptive force in the otherwise inflationary US healthcare industry. With just 1.42 million subscribers at the end of Q3 2023, and with a global population increasingly prone to chronic conditions, this company has a very long runway ahead. If indeed what I've just talked about is the result of extraordinary organizational properties, including extraordinary management, Hims has plenty of upside by simply carrying on doing its thing. What I found very tough to discern in my analysis of Hims is the competitive scenario, because Hims is barely 7 years old, and so the competitive information is scarce. But alternative data sources suggest Hims is well positioned against competitors. Per the reasoning that I will explain coming up next, I believe that Hims' exclusive focus on digital customers, coupled with its complex vertical integration, will pay dividends. Although Amazon is looking to enter the business, Hims' operation, I believe, is in fact highly defensible. Additionally, Hims is quite far ahead of its most direct competitors in the startup scene. like Roe, and I will explain why I believe this next. In turn, although I believe analog pharmacies will continue being relevant going forward, I believe they will not be able to delight consumers on the digital end of the spectrum as much. So, starting with startup competitors, there are a bunch of startups that essentially do the same as HIMS, with the closest competitor being a company called Roe. There is therefore plenty of activity in the private markets that we cannot fully get a read on. However, looking at the top 100 apps in the medical space in the US App Store yields some clues. For HIMS, iOS, with 28.4K ratings and 4.8 stars, is number 16 in the US App Store, with Teladoc just slightly ahead at number 12, with, of course, much more ratings, 518K, and a similar average review, which is 4.8 stars. What's very interesting is the following. Roe, which is allegedly a close competitor to HIMS, has just 2.2K reviews on the iOS App Store. And of course, it's positioned at number 89. So HIMS is positioned at number 16, Roe is positioned at number 89, with a fraction of the total reviews, although with a similar average rating, which is 4.8. Also, very interestingly, CVS's Caremark, so the app that CVS uses to interface with consumers on the digital end, is rated, comes in at number 35. So HIMS is very much ahead of both CVS, Caremark, and Roe's app. The first thing that stands out is that if we assume the same percentage of users leave a review for HIMS as they do for Roe, Roe is a much smaller company. Secondly, none of the other private market competitors are featured in the top 100 list either. It may therefore be prudent to state that HIMS has a clear lead on its startup rivals. Similarly, on Trustpilot, Roe has just 639 reviews, while HIMS has 3,340 reviews. It is also interesting to note, on a different note, that HIMS's reviews are worse than Roe's on Trustpilot, while this is not the case on the App Store. So another interesting data point. Further, the HIMS iOS app was only launched in January 2022, and it already ranks ahead of CVS's app and just behind Teladoc's, which has the largest healthcare data repository in the US. For additional context, CVS's app was launched in March 2013, and Teladoc's was launched in 2013. So they've been around for a decade, and HIMS is now ranking above them. In just a year's time, HIMS is ranking among peers with vast distribution advantages and highly established brands. Much like the string of unlikely events analyzed earlier in the deep dive, this is either another statistical anomaly or the result of exceptional management, and I tend to believe that we are witnessing the latter. Following my Teladoc deep dive and my latest update on the company, my qualitative impression is that they don't know what to do with their patient data. They are meant to use it to unlock longitudinal medicine, but per the evolution of the average revenue per patient, they don't seem to be making progress. HIMS has taken a different approach, which is building an entirely new infrastructure to make the healthcare experience better from scratch. In turn, this generates data, which, unlike Teladoc, HIMS can use directly to make its underlying infrastructure even better. Competitively, HIMS is therefore in a more interesting position to bring longitudinal medicine to life, since data is accretive to its service. On the other hand, Teladoc has to modify the existing healthcare system for the insights its data generates to be valuable at all. This is not to say that Teladoc won't go anywhere, but rather that HIMS has an infrastructure with the adequate properties for it to snowball over decades. The feedback loop between its data-driven insights and its healthcare infrastructure is much faster than Teladoc's, which on the contrary experiences plenty of friction dealing with the existing healthcare system. HIMS currently focuses on stigmatized conditions, which give it a stronghold on a corner of the market. By carefully picking additional verticals and conditions to treat going forward, which management has demonstrated that they can do, there's no limit to what percentage of the overall healthcare market they can address. Now, moving on to CVS and Walgreens. Taking a step back, the US pharmacy market is essentially a duopoly between CVS and Walgreens, Although these two companies have tremendous distribution advantages and are taking steps to digitize, I suspect they will not be able to meet digitally native customers quite how Hims does it. Check out this graph that I'm sharing on the screen now. Here you can see how CVS and Walgreens have the lion's share of the market, the pharmacy market in the US. And then after that, it's a long tail of perhaps other pharmacies that you may have heard of, such as Walmart stores, Optum RX from United Health, and so forth. But it's essentially a long tail, and these two companies take the lion's share of the market. So it is, you may agree with me that it is actually a duopoly. To be clear, the overlap between Hims and these two companies is currently small, but they are on a collision course. Hims operates outside of the PBM/insurance arena, but it effectively competes for the same mindshare. As Hims expands its offerings, competition will get tighter. 10 years down the line, a future in which Hims runs hundreds of proprietary facilities across the US and treats 100 Americans is not inconceivable. This would be a considerable counterweight for both CVS and Walgreens, and especially if Hims manages to take share by lowering prices below what insured patients pay out of pocket. So in other words, especially if Hims just continues doing what it's been doing since inception, certainly over the next decade, customers will come to expect increased convenience in the digital realm, and healthcare prices seem set to continue spiraling upwards. Therefore, the macro drivers are in place for a situation like the aforementioned one to occur. And as examined at the beginning of the deep dive, Hims seems to have the organizational properties to execute successfully. Although there are many distinctions to be made between CVS and Walgreens, and the history of the fight between the two is fascinating and perhaps could merit another deep dive some other time, going forward, their weakness is also said to be their strength. Their physical presence is said to be increasingly important once the healthcare system moves towards becoming outcomes or value-based instead of transaction-based. So let me explain. In the current healthcare system, patients go through a process, and if it doesn't work, that's tough luck. In a value-based system, patients are constantly being monitored to ensure that treatment is working so that it can be adjusted if needed to maximize for the outcomes. Physically checking patients will be even more valuable going forward, and so both CVS and Walgreens are gearing up to capitalize on this opportunity. Per the comments of the CEO in Q4 fiscal year 2024, for example, Walgreens is already preparing to deliver gene therapy across its physical network, initially by engaging in trials. Although I'm sure gene therapy patients in the future would much appreciate a delightful app to manage their treatment, there's no substitute to physically modifying the actual genes. CVS's CEO Karen Lynch also has a vision for transforming CVS's role in the healthcare system, moving towards a value-based approach. And I actually link to a podcast, which is an interview of Karen Lynch in the written form of the deep dive, which I think is very insightful and can be very valuable in terms of learning where the pharmacy business is headed. Thus, while the implications of CVS's and Walgreens' physical infrastructure are not to be understated, I believe Hims' exclusive focus on the digital front will act as a crowbar for it to disrupt this duopoly over time, ultimately driven by lower prices, higher convenience, and a more personalized selection. Now, moving on to Amazon. Reviewing Amazon's Q4 2023 earnings call, I heard CEO Andy Jassy say something very relevant to this deep dive, and I will read the quote out for you. He said, "If you think about what we do on the retail side, adding a pharmacy capability is a pretty natural extension. It's something that customers had asked us for many years, and it's got more complexity to it than the rest of our retail business. So we have to think carefully about whether we want to pursue it, but customers so badly wanted it, and the experience we thought could be better. And we could be a meaningful part of changing that we pursued it." So interesting, and my main takeaway from this excerpt is when he says it's got more complexity to it than the rest of our retail business. So that is what makes me feel like Hims' infrastructure is defensible, because this is actually a very, very complex thing to do. Even more so to print positive cash from operations as they do. My intuition, as I was saying, which is somewhat corroborated by Jesse's words, is that the pharmacy business has tremendous complexity, and that in turn, HIMS's vertical integration is even more complex. At this stage, the combination of the digital front door with the automated backend, I believe, is a highly defensible operation. As you may know, I have encountered a number of smaller companies successfully defeating Amazon against all odds, mostly enabled by superior focus. This focus shows in how they are able to pull off one quote unquote impossible feat after another. Among them are Spotify and CrowdStrike, which I cover quarterly. To the outside observer, their continued success looks like a mere coincidence, but they are in fact finely tuned organizations with a high ability of navigating the unknown within their specific fields. They leave a trail right from the start, which over time becomes more visible to the market. The way HIMS has figured things out thus far seems to me like quite an evident trail, and positive cash from operations, as I was saying, is the cherry on the cake. At this point, I think I trust management to successfully navigate the healthcare market going forward because they have managed to be cash flow positive against all odds. So, my understanding of the pharmacy business makes it even more unbelievable for me that this management team was able to pull this off. The pharmacy business is large enough to attract Amazon and any other large retail operation, but I believe that HIMS's exclusive focus is likely to prevail. The other thing that's very interesting about HIMS is that they have recently deployed an AI solution to further accelerate its flywheel, making the company the first instance in the healthcare industry of a closed AI loop. And this is something that can be very, very important for the company's survival going forward. Let me explain why. In Q3 2023, HIMS launched MedMatch, which is quote unquote a proprietary service that deploys artificial intelligence and machine learning against the expansive dataset at the core of the HIMS and Hers platform. This is the sort of data science that I was alluding to previously when I was comparing HIMS's architecture to Teladoc's. HIMS can deploy this service for each of its verticals and immediately, or at least with much less friction, translate the insights it yields into productive modifications of the healthcare process without having to deal with the inflationary, slow, and costly traditional healthcare system. With nearly 1.5 million subscribers, and assuming HIMS has been storing the anonymized data, which I would hope so, MedMatch will see in one day more patients than a physician can see in 10 lifetimes. As HIMS continues to scale, this competitive advantage will continue to compound. Firstly, this is another sign of the company's relentless pace of innovation, which I find quite encouraging. Secondly, I believe, as I was saying, this is the first instance in the healthcare industry of an AI closed loop. So think about something like Tesla's setup, where they have the cars and people are driving them, and these cars are picking up data, which then goes back to a centralized server in which Tesla is using its own chips and the chips of other providers to essentially train AI models that then get run again on the cars. So that is the verticalized AI infrastructure, which is a closed loop. The system generates more data from which the system learns so that the AI models get smarter, and then eventually the system just carries on getting smarter and smarter. And so this is the first time I see this in the healthcare industry. And this is unlike Teladoc's system, which is, as I was saying, a feedback loop that is not actually closed. This is the sort of system that can really bring longitudinal medicine to life. So no one else is treating millions of patients while picking up data and immediately applying the resulting insights to iterate on the underlying and vertically integrated healthcare infrastructure. All other AI loops, as I was saying, require, like Teladoc, a modification of the sluggish traditional healthcare system. So I made a graph to explain how I see this scenario playing out. Essentially, HIMS and Hers is working on these three fronts at the same time. So as manufacturing efficiency goes up, HIMS can treat an increasing range of conditions for a price below out-of-pocket spend. So the price advantage is a very, very important component of the thesis. Then, as HIMS successfully treats more conditions, it can attract more and better doctors. And as HIMS continues to scale, it can capture more data, which can be used to train AI models. These models make patient outcomes better, per dollar invested in the business, which ultimately improves unit economics and thus boosts cash flow production. Certainly, other players have more data, but it's not so much about the volume of data as it is about the applicability of the insights that the data yields. A smaller system that learns faster will over time outpace a large one that learns slowly. Going forward, this loop should act as a tailwind for HIMSS, improving patient outcomes per dollar invested in the business. As I was saying, this should equate to improved unit economics, which should have the company printing more cash. For now, HIMSS treats a limited range of conditions and only serves a small portion of its served available market. But if my understanding of the company is correct, they will replicate their current manufacturing facilities many times over going forward. As they reach more customers, get better at manufacturing, and generally cure more patients, I believe the AI will become the company's most important asset. It will increase physician productivity by orders of magnitude and will non-linearly increase the company's operating leverage. Now, moving on to the financials, management seems highly focused on reinvesting cash into the business. This is fundamental for the long-term thesis, since scale is an essential competitive advantage in the healthcare space and, in turn, a key enabler of AI. This focus is most evident in the quarterly evolution of capital expenditures since early 2021, with management investing more and more in the business as it grows. Here in this graph, you can see how CapEx has been getting bigger as the business has been getting bigger, and especially in the last few quarters. So we can see that as management continues to succeed, relatively speaking, in terms of producing more cash flow and so forth, they really don't shy away from reinvesting into the business, and they don't seem to be too motivated, or they don't seem to appease the market and focus on producing a net income. They focus on reinvestment, and that's actually really important going forward because this is still a small company and it has to get better at all these components that I've been talking about and just reinvest and reinvest until it gets much larger. Because being large in the healthcare space is definitely a competitive advantage too. In Q1 2023, an analyst asked CEO Andrew Dudum why they raised revenue guidance for fiscal year 2023 by $75 million, but EBITDA guidance was only raised $2 million. Andrew's answer is a qualitative exploration of the graph that I just showed you. He said, and so really, I think as we take more of a longer term orientation to our investments, we just see so many different facets and opportunities to continue to drive growth across the platform. And so I think our focus right now is primarily on getting greater scale that comes both in the form of incremental users on the platform as well as the scope of offerings. And we just see so many different opportunities where we have room to deploy capital, lawful abiding by a capital allocation framework. So by that, he means when he's talking about the capital allocation framework, he's talking about investing in verticals that deliver a sufficiently higher return on investment. So focusing on profitability is an erroneous way to analyze HIMSS's financials. I want the business to grow and reinvest all it can into growing further. As such, I am delighted to see operating income hovering just under zero, with cash from operations taking off. I include the latter graph again for your convenience. Here are the graphs. So here you can see operating income converging towards zero. So definitely not lingering in these very negative values that we saw at the beginning of 2021. But here I don't see management striving to post a net income just to appease the market. They are keeping this just under zero, which I think is great because then the company doesn't have to pay taxes. And then they are focused on producing more and more cash, which is definitely what I want. I want the business to pay little taxes over time and produce cash and just reinvest it all into the business again at a high rate of return, which is exactly what the company has been doing for now. And this is especially evident with the increased cash production. This really looks like a company that's taking off. Additionally, 90% of the revenue is recurring because the business is subscription-based. Although financially this is excellent, I have a slight issue on the medical side, since my understanding of medicine enables me to see that many of these conditions are curable via holistic practices that eventually can get patients off medication. However, since the last time I did a deep dive on the company, I have come to accept that most people simply do not care. They want a pill that allows them to forget about their condition effective immediately. Also, the infrastructure that HIMSS is building is in fact ideal to pivot to holistic care once/if the world does want to go in that direction. Now, regarding the balance sheet, at the end of Q3 2023, HIMSS had $212.5 million in cash and equivalents, with just $2.8 million in capital leases and no debt. As ever in this sort of company, investors pay the price for this type of balance sheet in the form of high SBC, stock-based compensation levels. And you can see how they've trended in this graph that I'm sharing now. SBC came in at 17.3 million in Q3 2023, or 7.63% of revenue in the quarter. As I've said many times, despite this seemingly high number, reaching a conclusion about SBC based on the numbers alone is impractical. It comes down to one's understanding of management and whether they will burn shareholders or not. My impression is that Andrew Durham will not burn shareholders, I believe this at present, because he's actually running Amazon's playbook. When he talks about price, convenience, and selection breadth, he is basically replicating Jeff Bezos' words and now Andy Jassy's words. So I believe that the corporate framework that he has in mind involves not burning shareholders, but I could be wrong. And, unless you have very excessive SBC numbers, in which case it's easier to make a call, I think here the name of the game is qualitatives, as ever. To conclude, perhaps the one thing that I do not like about the business, and I've talked about this in the past, is the dependency on paid marketing. People just don't go around telling their friends about healthcare providers in general because we don't speak openly about health issues in our culture. This is why HIMSS relies on marketing to grow. However, there are a number of ways that word of mouth can take off, and especially so via the internet, in forums and things of the sort. The company nonetheless manages this dependency very effectively, and thus organic growth stands as a potential tailwind. If and when it does kick in, HIMSS's unit economics could be vastly improved. Otherwise, HIMSS is a textbook example of a company with extraordinary organizational properties that pulls off one impossible feat after another. In turn, management is focused on reinvesting cash and creating value long term. And they've been doing this very well. They've been reinvesting cash at high rates of return. The healthcare industry is a complicated one, but HIMSS management has proven they possess the ability to navigate this complexity. I would therefore at this stage be comfortable putting my money in their hands. And I very much look forward to analyzing the Q4 2023 earnings results, which I actually will be sending out too. And I was reading them earlier this morning, and I like what's happening. I like the direction the company is taking, and obviously so does the market, with the stock up 30% following the earnings results. So I think this could be an interesting company long term, and I'm tempted to make an investment. But I have to analyze this the last earnings call in detail, and I look forward to doing that. So thank you very much for joining me today, and take care until next time.